time. I started the mortgage business in 1996, and I've never quite seen anything like this, and I know none of us have in real estate or mortgage. It's been an interesting time. We went from an unbelievable market really before all this started, and credit was good, and we were making lots of loans, and then obviously things with the coronavirus put a little scare in everyone, and it changed things. It slowed things down, and it's been an interesting transition, obviously on the mortgage side, but on real estate as well. It's and I've never seen a roller coaster like we've been on. It's settled down over the last couple of weeks, 3 weeks, but we had a very interesting roller coaster ride there for a while, with rates, with product changes, with all those things.
So what's the latest? Today is April 28th. What's going on today? Kevin, I've got so many questions. I want to know, where are rates at? Because I know the refis probably influence, some of the rates with supply and demand, but I want to find out, is it harder, getting easier to get a mortgage? What kind of credit scores you see in? What about VA? I mean, there's just so much. Let's just chunk it down one by one. What are rates doing right now?
Rates are actually exceptional. Rates are in the threes, obviously. Well, let me back up. Rates are based on obviously lots of things for the borrower, correct? So it's based on credit score. It's based on the type of product. It's based on a lot of things. But I can tell you that rates are the best they've been in as long as I can remember. And we're talking low threes for, I locked somebody at 3 yesterday on a 30-year fix. So we're looking at really good interest rates in the market. Obviously, again, based on credit score, based on their situation. It's interesting you mentioned, and I'll kind of veer off just a moment, that FHA VA guidelines have changed a little bit, so rates have changed along with those, depending upon the risk that comes along with that particular borrower. But I can tell you, to answer your question about rates are exceptional right now.
Okay, so let's talk about how hard is it to qualify? I know things changed, and what about people who are on a temporary loss of job? How are lenders looking at that?
So that's an interesting thing. So there's temporary loss of job, or furlough, they're calling it, right? And then there's obviously, unfortunately, those that have totally lost their job. Those that are in a furlough situation, basically what they're doing with them is they are, if we can get a letter that's saying that they still have a job and how much money they're going to make and when they're going back, then we can continue to move forward with that based on that information. In most cases, they're going to have to be back in their job, have to start back before the first payments due on that mortgage. So that's a furlough situation, obviously. And there are several people like that. So there is now, if for some reason they are not going to be back to work before that first payment's done, we can use some of the unemployment income to qualify them. But again, most likely that's not going to be enough to get them where they need to go. As we know, unemployment income is very, very low. So, but the furloughed employees, we can continue to move forward because we know that they do have a job once they're able to go back. And we're hoping, obviously, based on this right now, that's soon.
Okay, so I heard some lenders out there that were talking about, and I know you've gotten some people approved with us that as low as 580 credit scores. Then I heard some lenders were saying, now we need a 700 credit score. Now I'm hearing maybe back to 620. Where are lenders at with that kind of thing?
Well, to answer your question, they're all over the place. And it's interesting to watch because, yes, the 700 with 20% down, that's Chase. Chase came out publicly and said, and they're basically saying they don't want to be in the mortgage business right now is what they're saying. That's the best way to do that. So they want a 700 credit score with 20% down. They've decided that they don't want to be in the mortgage business anymore. There are lenders. We are still doing.
Let me stop you for a second because
Sure.
I want to find out what other lenders do. But why would a lender not want to be in the mortgage business right now? What is causing that to happen?
Well, a number of things. One, Chase has got so many other lines of business. I've been in this business a long time and worked for big banks like Chase. And the problem with I won't ever work for a large bank again, and the reason is because they have so many other lines of business, Brett, that when there's risk in one, they decide they don't want to do that anymore. So today they want savings accounts, or today they want investment accounts because there's too much risk in mortgage. The reason there's multiple reasons there's risk in mortgage. One of those is that there are so many people that are asking for forgiveness on their mortgage right now. There's, I don't know, 6 or 7%, I forgot what the last statistic was, of people that are in forbearance right now. So that's a huge number. The other thing that's happening is during forbearance. So you've got when I make a loan, there's two parts to that loan, right? There's the actual instrument that goes to Fannie Mae, it goes to Freddie Mac, it goes to Ginnie Mae, which is FHA, right? And then there's the servicing piece that goes somewhere, and it could go to a major lender. We actually here at Norcom, which is the company that processes my loans, services a lot of loans. The risk right now in the mortgage business is that for those servicers, because those servicers still have to make payments to the instrument, even though me, you, whomever may have asked for forbearance is not making payments to them. That's a big risk factor right now for mortgage companies in general. There are all kinds of loans that the minute they're closing, they're going into forbearance. It's just a mess. So the risk, they've just backed up. They've backed away from that. And that leads me to, the 680 to 700. Chase is saying, yes, we'll do loans 20% 700's credit score, where they know that borrower is not going to go into forbearance, right? There's no risk in that loan. So that's why they're doing that right now. And basically, they're honestly, like I said, they're just shutting the faucet off.
What happens if the servicer doesn't have the money to pay the instrument? I mean, could that potentially happen?
Oh yeah, absolutely. They could run out of money pretty quickly, actually. And there are multiple things that are, and this is beyond. I watch it, I read about it, and I'll be honest with you, I'm not an expert in these things. I watch it on. I'm subscribed to several different things. That is a big concern, is that 3-4 months down the road, these servicers could run out of money. They could be in trouble because they're unable to make those payments when they're not getting them themselves. Now, again, this is the part that's beyond me, but the government is getting involved, and along with all the other things that they're doing to help people in the economy, they are getting involved to assist with the servicers to keep them alive, because we could very easily see servicers start dropping like flies if there isn't some help there. And I know that's in the works. And again, I'll admit that I'm not going to try to talk about that because it's beyond my knowledge level.
So let's talk about who does have tolerance for risk, who is writing loans right now. So maybe, and that also brings up another point. So maybe I've banked with Chase for a long time. It doesn't always make sense to go to who you bank with. You need to go to who is most willing to work with you and give you the best terms.
Correct. And there are many out there. I mean, I'm a mortgage lender, so I'm not affiliated with a bank. I'm not a broker. So as a mortgage lender, I have the ability we process, underwrite, and close our own loans and service them at this point as well. So we handle everything from the beginning to the end. That the beauty of that for me is that I have control over that. We are a direct seller to Fannie Mae, Freddie Mac, and Ginnie Mae. So meaning that there is no middleman between us and those guys. We're selling directly to them.
So what are your programs right now? Let's break it down. We've got conventional loans, then you've got some government, you've got the VA, the FHA. What are you guys doing, let's say conventional? What kind of credit scores are you generally looking for?
Well, conventional traditionally needs you always have needed a 620 for a conventional loan. That's always been the kind of the guideline. That's for Fannie Mae. Freddie Mac says they don't need they don't have a minimum credit score, but we still use 620 as an average for conventional loans. So that really hasn't changed much. Conventional loans haven't been affected as much as really government loans have. So 620 is kind of the mark for a conventional loan. You can go down to as little as 3% down with a conventional loan, and those are priced well right now. So conventional loans good. The issue that you run into I don't want to say issue. The difference between a conventional loan and the FHA and VA is conventionals is a little more strict on guidelines. They're a little more strict on ratios. So that's one of the reasons we used FHA and VA so heavily, is because FHA and VA will allow large, higher back end ratios for qualification. They'll allow some other things with gifts and that conventional loans won't. So that's why we tended to go that way a little more that in the past. So conventional hasn't really changed a whole lot in our world. And speaking for me now, FHA and VA has, and we are all still doing loans down to 580. There is a different, everybody has a different set of rules that go with that. And I will say that there are lenders, and I think I said this earlier, there are lenders out there that are doing things that I won't, and we're doing things that they won't. It's interesting how everybody has, and it's what they're called is overlays, Brett. So Fannie Mae, Freddie Mac, Ginnie Mae, they give FHA, VA, they give us a base set of rules. Here is our rules that they give to a lender. Then any modifications to those rules are called overlays. When we started this whole thing, I had very little overlays, if none at all. Now the overlays in place, for example, are going to be pricing. So when we were talking about rate earlier in the conversation, when you're down at 580, your rate's going to be, unfortunately, it's going to make you not qualify right now because of that. That's in my world. I know there's some other lenders out there that are doing a little more, a little better pricing on 580 credit score than I am right now. We can still do those things. There are some reserve requirements that are in place with a lot of lenders. So a reserve requirement might be, okay, we'll do a 620 credit score, but we're going to require you to have 6 months principal and interest, taxes and insurance, PITI reserves somewhere. That can be in a 401k, that can be in the bank, that can be, but they're going to require some sort of reserves to make sure that that there's less risk in that loan. So those are the things that are kind of changing.
What about FHA and VA? Are they requiring reserves?
Yes, some are, and again, that's an overlay. My company is requiring reserves depending upon the level of credit score that they're at and their debt to income ratio. So it's kind of a moving scale. So yes, you are starting to see reserves, but again, there are other companies that are doing other things. I can really only speak for us.
So if you've got like a 680 credit score, you may not need as many reserves as someone with a 620 credit score.
Absolutely correct.
Or a debt to income ratio, let's say it's at 38%, not at 42 or something.
That's correct.
So how high on the debt to income ratio can you go on those government loans?
Well, traditionally we were at basically 56 was kind of the number that we wanted to be at, under 57. And we've really trimmed that down to 50 at this point. And again, that's based on credit score. And debt to income ratio, those reserves may go up or down, but 57 was the number before all this started. 50 seems to be the mark now, which is interesting. I was talking about earlier, conventional tends to be more in the 45 range. So that's why we would go to an FHA or a VA, because they would allow a higher back end ratio for borrowers. So that's one of the reasons we would go there. And remember, all this is backed up too, and we haven't mentioned this, all this is backed up too by automated underwriting. So we all use automated underwriting, which is DU and LP. Those are Fannie Mae and Freddie Mac's automated underwriting systems. And we use those for FHA and VA as well. So a lot of those are still, those are still in play, meaning that if we get an approval from Fannie Mae, from Freddie Mac in their automated underwriting system, then we can run with that as well. So, that's what a lot of this will defer to is to that automated underwriting system.
I've been hearing about two issues out there in mortgage land, and one of them is lenders going back and doing a re-verification of employment right up maybe on the day of closing.
Right.
And the other thing I've been hearing, and that's nothing new really, but it might be really true right now. And the other thing I've been hearing about is they're asking for employers to give a letter, almost like a confidence letter of what's the chance of continued employment in this environment right now. And that presents two issues. One is, are we going to have to do some layoffs? And number two, do we have anyone in HR right now that's authorized and in the office to sign that kind of letter?
Right.
Are you seeing those issues right now?
We are, and absolutely, we always have verified employment basically the day of closing or the day before closing to make sure that they're still employed. So that's nothing really new. What's changed in that more, Brett, is just what you said, is that the documentation to prove that, because you're right, there may not be someone there to answer the phone to tell us that, yeah, Mr. Smith, Mr. Jones is still working. And so we are using alternate documentation to do that, which may be they're allowing us to use a recent pay stub. So if they just got paid on Friday, we know they're still working, right? And it's still the same income that we qualified on. It's not a reduced income. Okay, well, we can't get a hold of HR, but we've got a pay stub, so they're allowing us to use that. They're allowing us to use a bank statement that shows a direct deposit. Okay, that direct deposit matches up with what the income that we qualified, so we can use that. So yes, there is we do have some flexibility on that now, which is good. Self-employed borrowers, you kind of mentioned continued income. Seems to be more the self-employed borrowers were requiring a third party, meaning a CPA, to write a letter that's stating that their business hasn't been affected, their income is going to continue. Because with a self-employed borrower, remember, you're looking at the last 2 years. I don't have a pay stub from a self-employed borrower from last Friday. Not necessarily. Sometimes I do, but most self-employed borrowers, even if they're paying themselves a salary of, I don't know, $30,000, the bulk of the income we're qualifying them on is from tax returns and from distributions and those things. Well, I'm going by 18 and 19 tax returns, let's say. Obviously, that doesn't tell me what's going on in their 2020 life. So when it comes to a self-employed borrower, they're asking that we get some sort of third-party verification. That could be if that self-employed borrower works with one specific vendor, right? They're a contractor and they work with one specific vendor. We could use that vendor to confirm that they are in fact still working and receiving. Or we would use a CPA, and a CPA could give us a letter stating that.
How about unemployment check? Could you use that as income?
Well, you can. The problem, unemployment can be used as income only in that furlough situation we talked about. So not really is the unfortunate part, because it's not going to be enough money to make it work anyway. What are they saying? It's $275 a week plus, I think they're doing $600 a month extra. So it's not going to be enough to get them where they need to go. In some states, it's a much larger number. In Florida, it's not.
Right. Okay. We've got some other agents on the team. You guys are out in the field working with buyers all the time. Any issues you guys are seeing in terms of your buyers and any credit needs or any mortgage issues you've been seeing, or has everything pretty much been smooth sailing? Anybody want to chime in? Looks like smooth sailing right now. I know we've got Kevin.
Well, everything's been smooth so far, but one thing that I was asking is, if I remember right, Kevin, you had like first responder benefits or a loan program like for doctors and teachers, I thought, or first responders.
Right. Well, and what's, unfortunately, there isn't a specific program for them, which I would like to think that we would put something out like that after what we've gone through and those people have had to work the way they've worked. But what I have is the Homes for Heroes program, which is basically, it's a program where I give them a discount on closing costs and things for that. There isn't really a specific program for them. It's more me giving back to them on the side of closing costs and things, Kevin, is what
Okay.
that program is.
Okay, that's nice of you to do that. I know that everyone's working hard out there for us. Keep us safe.
Absolutely. So yeah, unfortunately, there's no real programs out there that are mortgage specific programs for them. It's more just that type of thing.
Okay, thank you.
So Kevin Robbins, what else are What else are you seeing? What else should we be asking that maybe you run into that we're not asking about?
Well, I mean, I think you've covered a lot. I do believe, and again, this is my opinion. I am no expert. I do believe that we're going to see, once we're able to get our economy back going. Hopefully, that soon we're starting to see states bring people back. You know, all I can hope is that we don't see a resurgence of people getting sick with doing that. I do believe the mortgage industry is going to settle down, and I believe things will start coming back soon. We've seen, Brett, and I know you churn the numbers, and I think I'll almost turn this around to you for a second. I mean, tell them people are still buying, people are still listing. We're still seeing people out there that have an interest in real estate, and that's a good thing. And I believe that the mortgage industry will come back to that once the risk is gone from the market, and I think that'll be relatively soon. Will it go all the way back right away? Probably not. No different than our ability to go to the restaurants will go all the way back right away. But I believe it will come back and keep us going.
I want to ask you a question here in a second, but it's kind of interesting. So I went around the room this morning on our team meeting, and I just asked, what kind of sales have we had recently? And the buyer specialists that were on the call, and we didn't have all of them, but we had done 6 recent buyer side deals. And then I'm aware of a couple others. And then, of course, Sandy and I have some listings that have been selling. So our team has probably sold 8 or 10, let's say 10 deals in the last 30 days, all while we've been shut down under a stay-at-home order. So
Right.
we're considered essential, but most of us have been working at home. Like today, I'm at home.
Right.
We're practicing social distancing and whatnot to the extent that we can. And yet we've sold, let's say, 10 homes in the last month when everything shut down. So just because stuff is shut down doesn't mean stuff's not going on. We
Correct.
know buyers want to buy, some sellers want to sell. Maybe they all want to sell, but they may not want to show their home. So we've just
Right.
found a different way to do it. So that actually, I'm going to divert my question. Has your loan process changed through all of this? Are you meeting with more people like we're doing right now? Have you done any of that?
Interestingly, with technology the way it is, the need to meet with a mortgage client isn't much at all. As much as I try to, I believe it or not, there are many clients that I work with that I never meet in person until closing, if I'm able to go to the closing. So actually, my business hasn't really changed the way I'm doing things, other than where it's changed, Brett, honestly, is communicating more to my referral sources, because I can't do a lunch and learn with you now. So I've got to do some seminars that you've seen that I'm doing. And so my business has changed more in the way I communicate with my referral sources than it is my clients, because the technology is there that I can pretty much do everything electronically with my mortgage clients and not have to see them. And this is a texting society. If they can do it via text and over the internet, most people will happily do that. The older generations sometimes will not. So to be honest with you, no, my business hasn't changed a lot on the client side, but when trying to communicate with referral sources and business partners like you guys, that's where I've changed how I'm doing things. And I want to share a statistic with you that came out from the National Association of Realtors. I posted the other day. We were talking about buyers and sellers. It says 97% of sellers are modifying how they sell, but only 10% of buyers are holding off indefinitely. So that was a statistic that just came out, and I've got a really cool chart that I posted the other day on my Facebook. So yeah, there are still people out there buying. Now, what I would say is that we may be in a situation where we've got to do a little more work now. You mentioned earlier that I have taken on some tough clients of your teams and got them done. We had to fix their credit. We had to raise their credit score. We had to take care of some things. Now that's a little bit bigger hurdle, right? Because I can't, because we may have to get them to a 620 to get them done, as opposed to a 600 or whatever the case.
At least we gave you some good practice, so you're prepared for this now.
Exactly. Well, and so what that means, though, is that doesn't mean that those people shouldn't start the process now. now is a good time to start the process to begin working on getting to that point. So so we can get them ready to buy, and hopefully, if the guidelines loosen up a little bit and we've brought them up a little bit, they'll meet somewhere in the middle. So I still believe it's a good time to start the process and at least get an idea of what you can do. I mean, I've got multiple people in my pipeline right now that are not working. They know they're going to go back to work. And so we're basically getting them ready. We've got their loan, we've got their documents in, we've got their loan put in place. I've run credit. We're working on a few little credit things. We're we're staging them, if you will, for a lack of a better term, getting them ready to go as soon as they get back to work, and we can hit the ground running.
I know you talked to the head of the Mortgage Bankers Association. What are they telling you in terms of what are they predicting for the balance of this year?
They're amazing rates for the rest of the year, which is good for us, and into next year, which is what they're predicting. And believe it or not, everybody is very, very confident about the real estate market. They feel that we're in a good position. And I'm the ultimate positive person. I believe we're blessed to be in Southwest Florida, and I think we're in a different position than a lot of places because people want to come here, and so that helps our market a lot. But it's positive. It's positive. Our rates are going to stay low. Again, if we can get past this and get going, I own another little side business that I talk to a lot of people, and what we've got to remember, what's different about this dilemma than what we went through in 2008 is that there are still tons and tons of people working that weren't affected by this. Now, unfortunately, many of my friends that are in the hospitality industry and are horribly affected by it. But there are still a lot of people making their regular salaries, especially our first responders and all those people. They're still going to work every day. And there are many, many people still working from home that have not been affected by this whatsoever. Our retired community hasn't been affected by this whatsoever. They're still receiving their pensions, their distributions, whatever the case may be. So though, and our stock market scared us there for a few days, right? But it's back. And so their investments are doing good too. So we have, when we come out of this, we've got people that continue to make money, that are still in good positions, that are ready to buy. And I don't know, I'm very positive about where we're at and the opportunities that we have.
Yeah, and I've heard two schools of thought. There's some people that are doom and gloom, and they think the stock market's going to crash. They think real estate's going to crash. But this real estate market is nothing like the last crash because we have low inventory. We've got end users for everything back then. So already a few of the deals that were lost that I found back in March, I'm just wondering if they're not already regretting that decision because inventory is going even lower and sales haven't stopped. So what they feared hasn't come true. Now, right. I can't predict the future. You can't predict the future. Probably NAR, the Mortgage Banking Association, probably nobody can predict it for sure. But right. So far, we haven't seen that, have we?
No, I'm a very positive person, so I feel good about where we're at. I feel good about where we're going, and I think, I just hope that we can safely come out of this. Hope our governor soon will safely bring us out of this, and we're able to hit the ground running again. And Brett, I don't know if you saw, there's a couple of questions that have popped into our queue here that I want to answer real quick. One of them was, do I do investor loans? Yes, investor loans are still out there. Investor loans, generally, you're going to want at least 20% down on an investor loan right now. 25% down is going to get you your best interest rate on an investor loan. That is a conventional conforming loan. Rates, I'll be honest with you, I haven't looked at investor rates in a little while, so I don't want to say what they are, but absolutely we can do investor loans, and I can do up to 4 units. So as a residential lender, I can do up to 4 units for an investor. So a single, duplex, quad, whatever, I can do that. Another question, Brett, was, do you have first-time homebuyer programs? Well, the first-time homebuyer programs are The down payment assistance programs that are out there have been slowed down or stopped again because of the risk factors that are along with them. FHA and VA, VA is 100% loan for an eligible veteran. FHA only requires 3.5% down. The down payment assistance programs are there to help with those people that don't have any money to put down. But generally, oftentimes I'm able to help them figure out a way to find the money, that 3.5% that they need, whether it be a gift from a family member, something like that, so that they don't have to do, because the first time homebuyer programs are there. They're great programs. My opinion is that sometimes they're very labor intensive to process and close, and they're sometimes more expensive for the client than if they were able to find the traditional 3.5% down. So first-time homebuyer programs are still there. Yeah, that's in my opinion, that's an FHA loan. Yes, there are down payment assistance programs, but a lot of those have been put on the shelf until this all settles down as well.
I got another question for you.
Sure.
And I think you're doing a seminar to agents about renovation loans.
Mm-hmm.
Are you doing those? And so let's say I'm a buyer and I find a property, but it's got some work and I want to put a pool in, or I want to change out the kitchen or that sort of thing. What's going on with that in these times?
Well, that is a specialty of Norcom, the mortgage company that I'm affiliated with, is renovation loans. And so a renovation loan is very simply this. In a nutshell, you take the house, the existing home, you take the modifications that you want to make to that home, whether it be a pool, a new kitchen, a new roof, whatever that may be, right? You get a contractor to give you quotes on those. You put all that together and you appraise that property as if that work has been done. And then that's what we end up lending on, is the finished value, similar to a construction loan. If you've done any new construction with a construction loan, you give the appraiser the plans, and the appraiser is giving you an appraised value based on if that property was finished based off the plans. So basically we're loaning based on the new value. So we purchase the house with at closing, then the rest of the funds, and this is a quick down and dirty, the rest of the funds stay in escrow and are dispersed to those contractors as
almost like
done.
Almost like a construction loan.
Exactly. It's exactly is what it is. It's a construction loan, but with an existing house already there. So, and we can do those as a purchase and or refi. So, if somebody's sitting around in their house right now and we see there's a line out the door at Home Depot and Lowe's and everybody's wanting to fix up their house. So you can do that as a refinance. You could add a pool or whatever. But as agents like yourselves, if you're showing a property that they just love the house, but they wish it had this and this, great location, great schools, but it doesn't have a pool, or boy, I'm not comfortable with the fact that roof's 20 years old, whatever, we can look at doing a renovation loan for them and possibly get in. And also as an agent, if you've got that listing that needs a little love, right? I was a realtor back in the day. We've all had those listings that need a little love. That's another way to market that listing is, hey, we could do a renovation loan on this and possibly get those things taken care of.
So I got a question for you. Let's say I got a house worth $330 or something like that, and it's got an older style kitchen. So let's say bids come in at $35,000 to redo a kitchen, and we could easily be talking about a $15,000 roof if it's shingle, or 40 or 50 if it's thing, or maybe a $40,000 pool, same thing. When that appraisal comes back, are you seeing the $330 value that it's worth today, plus the $35,000 kitchen? Are they coming in at $365, or are they cutting that kitchen back a little bit, and then it causes the buyer to have to come up with more down payment? What are you seeing?
Well, I will tell you that appraisals have been a little squirrely lately because I've seen that appraisers are telling us they don't have the comps that they want right now for whatever reason. I've had a couple of condos that have come in lower than I thought they should because they're saying the comps aren't out there. You are right, Brett, and I can never predict what the appraiser is going to say, but you're right. If they over improve that kitchen, the value may not increase the house's value. As you know, you guys do comps every day. That fancy kitchen, they still expect a kitchen, just like a car expects tires, right? They don't care if it's fancy tires. They expect it to have tires. So yes, you can run into that maybe they're not going to get the full value of the cost of that kitchen or the cost of that pool. That could possibly happen, yes. And I would invite your agents, and I know we're more directed at borrowers in this, but I would invite your agents to join us on that renovation call. And any clients that are interested in learning about renovation can reach out to me, and I'll be happy to share that with them, because there's a lot of moving parts to the renovation loan. There are multiple different loans that we'll do with renovations. So, but to answer your question, it could possibly not appraise. You could possibly not get that full value for that kitchen or that pool if it's because, again, we expect a kitchen to be there, right?
Right. So before we get to a couple more questions, why don't you, we'll put it in the comments too, but why don't you tell everyone how they can get a hold of you? Name your company, your phone number, and your email address real quick.
Okay.
Because I want people to be able to call you if they've got questions.
Right. So Kevin Robbins, of course, Robbins Mortgage Team. We're powered by Norcom Mortgage. Easy. It's robbinsmortgageteam.com. 2 B's. Robbinsmortgageteam.com is my website. My email is kevin@robbinsmortgageteam.com. The best number to get me is our main number, 239-208-6610. That comes into my team. And I'm blessed to have my daughter by my side. She is my, I hate the term loan officer assistant or loan partner. She works with me every day. And I know that many of your agents have talked to Casey throughout the process. So it's a family, it's our family helping your families. And that makes me very happy. I love having her as part of my team.
Well, that's one of the reasons we like dealing with you, because we get straight up advice, and it's always good advice. Another question came in: when customers get qualified, how long is that approval good for?
Well, I tell everybody on the document we'll say 60 days, but basically it's good for as long as nothing changes, right? So and that's the truth. So if you come to me and you make $60,000 a year and these are your bills, and then as long as nothing changes, your pre-qualification pretty much stays the same, right? Excuse me, just one second. What could change that, obviously, is if they go buy a car with a $500 car payment, or if their salary changes somehow or whatever. So 60 days is the correct answer, but I tell everyone it's going to be as good as long as nothing changes, right?
Right. Another question came in is asking, do you know if there are any change requirements to the 1031 exchange program due to the coronavirus?
You know what? I don't know the answer to that. I have an expert that is on speed dial for 1031 exchanges. I see that came in from Sandy. If you've got some specific questions, Sandy, you can email him or call me after this, and I've got an expert on speed dial. It's a good friend of mine that is my 1031 exchange expert. I've not heard any, but that doesn't mean I haven't had to deal with any 1031 exchanges recently. So I don't know the answer to that.
Okay.
Okay. Very good. Any other questions? Anybody? I'm starting to run low on questions, Kevin, because you've answered most all of them. Anybody else got anything? Gayla?
I'm good.
Okay,
Good.
for parents that are dealing with college debt, either that they have co-signed on, or maybe that they have a Parent Plus loan on, how does that play into your debt to ratio income or your debt to ratio?
Unfortunately, if they're co-signed on it, the student debt is held against them.
Right.
Because in most cases the student debt is deferred, right? So there isn't any current payments on them. Where and I'll shift gears for a second. Let's say mom or dad co-signed on a car for their son or daughter, and we can prove that that son or daughter is making the monthly payment via a check or via direct deposit or whatever on that car, then I can take that car off of their obligations, right? Because I can prove that the child is doing that. And by the way, I'll share this with you, the agents, and anyone who's watching, that if you ever co-sign for someone and they are paying the bill, make sure that they're paying with a check, so that it can be documented that they're making that payment, so that we can take it off of your obligations should you need to apply for credit. Oftentimes I'll have someone say, my daughter makes that payment. Well, the daughter just goes in and puts money into the bank account cash. Well, that I can't track that, right? So I can't prove that the daughter is making that car payment. So the problem with student loans, to go back to your question, I wanted to kind of give some perspective there, is that student loans are often deferred. So there aren't being any payments being made on them, but unfortunately we still have to use those as debts against the parents because they have signed on them. And I've run into that multiple times, and have gotten, there are all kinds of things you can do to rework student loans to get people qualified. And there's a lot of moving parts to it, where I've had clients that have called in, and I'm not a student loan expert, but I know that they can call, get them refinanced, get them modified, get them worked out where we can get them qualified. But student loans are tough because they're there, and even if they are deferred for the borrower or the parent that co-signed, we still have to use that against them. Even if it is deferred, we have to hold some amount of debt against them in most cases. There are a few exceptions to that.
So Kevin, let's say the student is now gainfully employed and they've been making payments. How long do they have to be making the payments for you to not assign that debt to the parents for the purpose of getting a loan?
Well, 12 months is generally the key for that. So 12 months on the car, example that I used earlier, 12 months on the student loans if the child is paying them. In most cases, what I would say is, if the child is now gainfully employed and has those student loans, I would tell them immediately to get them refinanced and get mom and dad off of there. Is what I would say at that point. Mom and dad are signing because there's no income. No, the kids don't have anything. So that would be one of my suggestions if I had someone came in that had co-signed and needed to get them off of there.
Now, let's say they didn't use a check, but if it came out of their bank account, could you show their bank statements of the student or the former student and say, look, there's 12 months, every first of the month, $629 came out. Can you verify it that way?
Yeah, as long as it's going to the student loan, no different than my car payment to Capital One, for example. If it's coming out of my bank account and I've got it on auto pay and it shows whatever the number is to Capital One every month, absolutely. It has to just show that movement. So again, depositing cash into mom's account of $629 every month isn't good enough, unfortunately. We have to actually show it going from that person to the creditor.
Right, okay. All right. Good question, Gayla. That was awesome. Any other questions out there? Wow. Well, Kevin, you've been wonderful. Anything else we failed to ask you, or any other message you want to give that you think our viewers should be attuned to?
No, I think I just want to leave you with the fact that, and I said this earlier, but I'll say it one more time, is that if you're thinking about purchasing a home, you have the desire to purchase a home, even though times may not be great for you now, I firmly believe and always believe, and I'll say this to your agents as well as anybody watching, that get with a mortgage professional and get a plan together. Get a plan together. Start working on the things that you need to do to maybe repair your credit if that's the case. Pay some things down. Know what your numbers are. Know what you need to pay down or pay off to get to the ratios that you need. We may not be in a great position right now with the guidelines that we have, although they're still good and we can still get a lot of people done. I'm not saying that, but I think there's always a good time to if you have that desire, just get started. That's it. Speak to somebody. It doesn't cost you a dime, for you to go onto my website, fill out the application online, and I can pull credit. I can give you a snapshot of where you're at and see what works, and give you a plan to move forward.
So don't wait till you're ready to buy. Start a little bit ahead of time, and maybe someone like you can help them out and get them there. And one of the benefits of if you help them out, they're probably going to get a better interest rate than if they try to do it without getting help, because how to get those interest rates down for them, which will save them a lot of money.
Right, exactly. And we've had some of your clients where interest rates again are based on credit scores. So if they're at 618, 615, whatever, and they get a better interest rate at 620, I'll take the time to work with that borrower to get their credit score to 620 so that I can get them the better interest rate. So yes, absolutely. I do that on a regular basis. And we've got all kinds of really cool tools, what if scenarios in our credit reporting system that allows us to go in and see, okay, if you pay this credit card down, or you pay this off, or you do this, or you do that, your the credit score will go up to 620. Then I can get them the better interest rate. So absolutely, I do that. Even though I can get them approved and qualified and everything at 618 or 615 or whatever, I absolutely do my best to get them up to that next level so we can save them some money on that interest rate.
One of the things I appreciate about you is you're looking to do what's right for people, not just to get the loan in now and get it done. And that's one of the things I appreciate about all the agents on our team is they're looking to do what's right for people, not just sell them a house, any house at whatever it costs, only for them to lose the house because they made a bad financial decision, that sort of thing. But sometimes people get in a hurry and their lease is up at the end of July and they need to buy now. If we just would have had another month or two on the front end to work with them, we could have saved them a lot of money than waiting till we're right up against that lease date. So there's sometimes when we have to act quickly, just out of necessity, but if given a proper amount of time, we enjoy working with people and work with people like you so we can really do what's best for people.
Absolutely. So yeah, that's what I'm saying is if we can get ahead of the game with everyone, it puts us in a better position. Definitely.
So Kevin, probably one of the things we're going to want to do in the future is do like a home buyer seminar, and we're probably going to want a lender to come on and we kind of talk about the steps, how to search, what the criteria is, getting pre-approval, what the seller's going to want to look for in the offer, how the home inspection process works. Would you be willing to come back and help with that component for our buyers? And maybe we can even do a virtual home buyer seminar. Would you be willing to do that and help people out there learn what it takes to actually buy a home?
Absolutely. I have wonderful presentations for just that. And I would absolutely love to do that.
Well, that's good. That sounds like it. Let's schedule that one of these days. Okay.
Definitely. I appreciate it.
All right, Kevin. Well, thanks so much for being on. You're not only a great asset to our team, you're always a wealth of information, but you have done a spectacular job for a lot of our clients. And we try to bring you the best clients. Of course, the best ones are cash, so we can't always bring you those. But thank you so much for what you do for all of our clients and helping them out get better deals. And I just think that we're all in this together. So the more we can help each other, the better off we all are.
Absolutely. Thank you, Brett. I really appreciate it.
All right, sounds good. Thanks so much, and thanks for tuning in.
Thanks.
All right, bye.